Hello there! Part 2 of Tutorial Series 3 of Bite-Sized Corporate Reporting focuses on the application of the measurement principles of IAS 38 Intangible Assets. A link to the question is included in the description. Continuing from Part 1, we look at the next issue, that is the cost incurred in maintaining the game's performance. Any subsequent expenditure should be added to the carrying value if it's probable that future economic benefits associated with the asset is in excess of its originally assessed standard of performance will flow to the entity. This would include enhancing the useful life or productivity of the games. In this case, as the cost is incurred to maintain the games at the same standard of performance, Legend is correct in expensing of the amount to the profit or loss. Next, we need to deal with subsequent measurement. Legend has a choice of adopting either the cost model or the revaluation model. As Legend has opted for the cost model, the intangible asset should be carried at cost less accumulated amortization, less impairment loss, if any. What about Legend's policy of non-amortization as it considers the online games to have an indefinite useful life? An asset has an indefinite useful life when there is no foreseeable limit to the period over which the asset is expected to generate net cash inflows for the entity. According to IAS 38, computer software is susceptible to technological obsolescence. Therefore, Legend's policy of non-amortization, as it considers the games to have an indefinite life, is questionable. The next issue is Legend's policy to carry out an annual impairment test and annual review of useful life of the intangible asset. This is consistent with the requirement of IAS 38 for intangible assets with indefinite useful life. Finally, we need to look at how Legend has arrived at the value in use. Please be reminded a question may require application of principles from more than one standard. Here, the relevant standard being IAS 36, impairment of assets. The value in use should reflect the future estimated cash flows expected to be generated from the use of the asset, that is the cash inflows minus outflows, including the estimated net disposal value, if any, at the end of the asset's expected useful life. Therefore, Legend should exclude the cost of developing the different versions of the games and the associated expected increase in revenue, as it does not represent cash flow from the same asset. With this, we conclude Tutorial Series 3. Thank you.